Hello, everyone. Dennis Reed with Edgewater Research. Thank you very much for joining us today for our Navigating the Shifting Landscape webinar series. Look forward to spending the better part of 45 minutes to an hour with you. We've got a lot to cover. So with that being said, I will jump in. So just to start, before I run through the through the agenda, we will have moderators on the panel throughout today. So please feel free to direct any questions in the chat function. The moderators will be monitoring that closely, and we will be sure to address those either during or after the presentation. Our agenda for today. So to start, going to provide a quick overview of Edgewater, tell you who we are, what we do, etc. And then we'll dig into where we are in the current cycle before shifting to an overview of the supply side fundamentals, what we see exiting 2023, but more importantly in 24 and beyond. And then we'll dig through from an end demand or a demand side review of the fundamentals. Again, looking backwards just to tie a bow on 2023, but more importantly, providing our outlook for 24 and beyond. And then we'll wrap up today with our outlook for kind of major categories being the semiconductor marketplace, interconnect space, and then the passive space as well. So who we are at Edgewater, we're an independent research company that specializes in technology, internet and consumer / e-commerce. The company was formed in 2018. And when we built the company or started the company, really we had focused on these three pillars for a couple of reasons. First, we thought there was significant synergy between what we'll call our hard technology or the component practices with ultimately the consumer or e-commerce. So really trying to look at the supply chain holistically from, call it sand to silicon through to distribution, EMS, OEM, and then ultimately have at least a view on kind of the B2C transaction. But as we were growing the business initially, we quickly realized that the internet, this world of the internet, was of growing importance. When you think of it from a component standpoint, your cloud and hyperscalers, so your likes of like the Metas and Googles and AWSs, they're obviously massive consumers of the components or the raw materials. But likewise, when you shift it over to the retail side or the consumer side, they have a growing importance there, from the growth and proliferation of digital advertising. So again, we thought there was nice synergies and chances for collaboration across our practices. We service many of the largest money managers, both private and public in the world. And then we do provide what we call critical business insights through our process, which is known as fundamental research. Our reputation dates back well over 2 decades. So again, our team's been at it for 20 plus years, and collectively across our team, we have well over 60 years of experience covering this industry. So we've seen a lot, and we've been through a number of cycles over the years. And why do our customers work with Edgewater? One, we're deeply connected in the industry. So as I mentioned earlier, in the fundamental research standpoint, I literally spend my days, my weeks, my months interacting with people like yourselves on the call, sharing insights into what's going on within the business from, again, sand to silicon distribution, you name the point in the supply chain. We are a trusted resource, as I mentioned, for the investment community, both public and private. But equally as important, we're a critical partner with our technology customers, helping them shape their strategies in a changing landscape. What this means for you and our overall insight between servicing the leading technology companies and ultimately the leading investment companies. Not only do we get to see where the business is going, but we also have direct line of sight or insights into the funding mechanisms through the investment companies that are driving these growths. The growth in these trends. And again, for those on the call, How to engage with us. We have a couple of models to engage with us. I won't go through these in any detail. I know our partners at Octopart will make the slides available for everybody. A little bit about myself before we move on. Started as a research analyst in 2005. Did this for a number of years before transitioning to the insurance industry for a bit in 2013 through about 2020. I've been with Edgewater from 2020 until the current day, and very excited again to be with you. So my contact information will also be available in the deck. It's here on the slide if you want a screenshot. Please feel free to reach out. Would love to hear from you. As we shift from background and who we are to the cycle, what does this cycle ultimately look at? And this is a question that we often get from all of our customer base, whether it's financial or industry. How bad is it going to be, one, and then two, when are we going to dig ourselves out of it? So, we tried to look back to ultimately come to an answer to that question. And what you'll see that solid red line is our current downturn, which started in October of 2022. And out of the gate in the first 3 or 4 months, we were eerily close to the downturn that was experienced in the 2000 correction, which I think for everybody, they would agree that would not have been good. The good news is once we hit kind of the 3rd or 4th month, we did see some stability in sales. And I'm happy to say that I think it's safe to say that a long, deep correction is pretty much off the table. So now that we know this isn't going to look like 2000, what does this correction look like, and ultimately when will we return to growth? And really, I think there's kind of 2 proxies that you could look at from the chart. There's the solid gray line, which again is the October 18 downturn that was really just a standard issue, bread and butter, cyclical inventory correction, short, a little bit deeper, with a relatively rapid recovery. And then there was this 2011 downturn, highlighted by the blue line. And while they diverged a bit, I would tell you the way we're thinking about this downturn at Edgewater is kind of like the October 11th correction. So a couple of reasons behind that. One, when you think back to October 11th, that was the shortage that ultimately stemmed from a once in 100-year black swan event being the financial crisis. While the mechanism was different between COVID and the financial crisis, the impact to the supply chain was actually the same. We saw significant order cuts. We saw a rapid closure of factories, et cetera, et cetera, et cetera, both in 08, 09, as well as 2020, only to quickly have that business turn on a dime, leading into a relatively prolonged, call it 2.5 year upcycle before it peaked. So again, we think looking backwards, there's a lot of similarities into the upcycles coming out of once in 100-year events that, by all means happen every 10 to 12 years. But we think there's some similarities to that. So, that's looking backwards. Looking forwards, when do we return to the high water mark? And there's a narrative in the supply chain around this being short and shallow. And I would say as the data is proving out, peak to trough was a 10% decline. So excluding that November of 14 downturn, the narrative of shallow definitely holds true. So that is some good news. The side of being on the short side of it, that's where we're a little bit more suspect with it. And I would say, just this week, unfortunately, after this presentation had gone through the legal process, sales for November from the SIA did come out. They were positive for the year. So again, we did return to 100% growth, but I think when we're also looking at that as kind of a near-term high water mark with a less optimistic outlook through the balance of the year. And really the delta with that, and I'll talk more about this as we go to other slides, this recovery that we've seen and call it from month 8 through, 12-ish or so, that has by and large been driven by two things. One is the rise of AI investments, which is very real, and I'll talk about it on later slides. And the other has been simply memory pricing turning on a dime. And what I would say with the memory pricing, while memory suppliers have certainly had challenges in profitability, really they've been raising prices purely on their own supply actions. And we simply don't think, without a meaningful recovery in demand going forward, that those prices will ultimately continue to go higher. So again, how do we think about this going forward? I think it's safe to say the worst of it is behind us, which is the good news. But we're ultimately looking at what we call somewhere in the 21, 22, 23 months until we really truly sustain above the high water mark, which probably means we're swimming uphill through at least 2Q and into 3Q of this year. As we shift from the cycle and we look at the supply side, and this will be a common theme I think that you hear from me throughout the webinar today, is our real fundamental problem where we sit right now is not demand, it's inventory. And I think everybody here on the webinar knows and has heard the narrative through COVID. There's extreme shortages, lead times are out, et cetera, et cetera, et cetera. And while indeed lead times did stretch, as you can see from the data below, on a dollars basis, inventory bottomed really in 4Q19, and then proceeded to grow on a dollars basis every quarter from 1Q20 all the way until the inventory peaked in 2Q. I'm sorry, in 4Q22. So we saw substantial dollar increases throughout the entire COVID period. People were clearly hoarding inventory. It didn't mean the golden screw phenomenon wasn't real. It absolutely was. It didn't mean that we didn't have kitting issues. We absolutely did. But inventory was not lean throughout this entire process. Another, reply or rebuttal this that we often hear, and it's 100% right, is there was price increases, that's inflating the dollars of the inventory, et cetera, et cetera, et cetera. And I would agree with that to some extent, which is why we also look at days of inventory, which again on the chart on the bottom shows a very, very similar story. Days of inventory at their peak at their peak in 2Q of 2023 were significantly above where they were prior to COVID. And I would tell you that's kind of the problem that we sit right now. You can see the box that's highlighted in the red. We're comparing the third quarter data relative to 3Q19. So we're trying to normalize for seasonality looking at the same quarter. But when we look at versus the last pre-COVID database, pre-COVID data point, in aggregate, we're standing somewhere about 34% above pre-COVID levels on a days basis. Days, as we all know, is a function of both the inventory, but as well as the sales figure. So again, that measure we think adjusts for price, adjusts for the growth of sales, but again, shows a relatively pronounced inventory build and still an inventory headwind as we work through it in 4Q, and then as we turn the page here for 2024. So again, that's looking backwards, and inherently, unfortunately, the inventory data does look backward. While we'll start to see results coming in, call it sometime next week with fourth quarter financial reporting season kicking off, our expectation would be to see a decent level of improvement on a days basis, which is good news. Or I'm sorry, on a dollars basis, while days I think are potentially a little bit more challenged, just because the rate of sales slowing off or rolling off in the fourth quarter. So again, heading into the year for 24, I think we view this in a simple statement as a transition year, and I'll touch about that more when we get to the end markets. But really what makes it the transition year is inventory, while better, exiting 23 than 22 still remains a headway for us in the new year. And ultimately, how did we get here? This chart shows the capital spending for the major semi companies. And unfortunately, in our industry, we just can't help ourselves. In 2020, 2021, and 2022, we had a 3-year stretch of double-digit year-over-year CapEx growth for the semi companies. And I would tell you the last time that we had seen that was in 98, 99, and 2000, and ultimately we know how that ended. So as I discussed on the cycle slide, the good news is it doesn't appear like we're heading for a 2000 correction, again, borrowing any major geopolitical disruption, things like that. It looks like this is more of a cyclical inventory correction. But the bad news is, or I would say the narrative that we'll never ever, we'll be in this perpetual state of shortage, from our camp and based on the capacity that we've seen installed, we just think that's unequivocally false. As we shift from the supply side and we move over to the demand side, I'll start here with the PC market. And I think, the PC market probably is one of the best markets that encapsulates the challenges that we've seen really across virtually all end markets. So I have PC shipments here broken out quarterly, and you guys can all see the trend. But what I would tell you, and what sticks out to us, is PCs prior to COVID was roughly a 275 million unit market per year, plus or minus a couple million, depending on OS, upgrades, refreshes, etc. We went from 275 in 2019 to 320, 330 in 21, and then about 315 million in a down year in 2022. In those aggregate 3-year windows, we have shipped into, or actually a better way to say it, we have pulled forward roughly 100 million unit demand TAM. We have pulled forward into a 3-year window. So what does that mean going forward? The good news, I think is anybody who deals with the compute space, 2023 was a really, really bad year for PCs. The units were roughly in the 250 to 255 range. So again, about 25 million under that trend. That, while it's tough in the near term, that's needed to happen. So as we shift from 23 to 24, our outlook, and this was confirmed when our team was out at the Consumer Electronics Show last week in Las Vegas. When we look at PCs for 24, it really is a transition year with no reason for an upgrade cycle and no quote unquote killer product or killer application to drive a sale. So we're looking at the PC market this year. The good news being it's probably up. We're not thinking we decline again, but our increases are only in that 2-3% year-over-year growth. So again, we're going to well undership trend this year. There are talks in speculations, and we see the articles around moving AI to the native machines, or pulling the AI systems out of the cloud, and that's going to be a major catalyst for unit growth. What I would tell you is in 2024, we don't see it as a catalyst for a couple of reasons. Number one is purely on a hardware side. Currently, AMD and Intel CPUs are not viewed as powerful enough by the OEMs to pull that cloud, or to pull that AI functionality from the cloud to the native desktop. So we've got a hardware limitation, one. And two, I think, which is more indicative of kind of the broader cloud AI space, we've ultimately got a user face and/or you could say use case scenario where right now we don't see the applications necessarily built in the current environment at the start of the year. That's not to say they won't arrive throughout the year. They will, but where we sit right now, the use cases and the interfaces are really not available right now. So again, we think this is much more of a staging year in terms of PCs before seeing hopefully a lift or an improvement in 2025. As we stick with compute and we move from PC to server, it's really a tale of three different markets right now. When I start, and you could see our forecast, units were roughly flattish overall for 2023. And what I would tell you, the breakup of those units would be your core server units down in the single digit range, with AI units going from roughly 75,000 units to about 450,000 units last year. So the growth in AI is real. AI is a real market. Those are all good things. The challenge with AI is we're looking at roughly a 12 or so million unit marketplace that unfortunately a 400,000 unit number is not going to move the needle here in the near term. So as we shift from what happened to what we think will happen, again, we still see a tale of three markets. So starting with your enterprise on-prem environment, we still see that market relatively soft or relatively challenged. And really that's driven predominantly by macroeconomic concerns, cautious CapEx spending, and then ultimately kind of that pull forward of demand and spend with an underutilization as employees have not yet fully returned to work. So that's the enterprise on-prem outlook. When we shift over to the core data center, so now non-AI based, that's a market I think that ultimately disappointed in 2023. And at the current stage, we do see that as a headwind looking into 2024. And really the challenge with the core data center stems from a couple of reasons. One, there's just a general conservatism around CapEx spending in an uncertain macroeconomic environment. I think that's natural, and I don't think that's the major driver behind it. Two, there was an underutilization. We saw significant CapEx, significant data center build-outs throughout the COVID years. The data center marketplace really is a field of dreams type business where if you build it, they will come. So the data centers were all built out, and now we need to ultimately grow into that capacity. And that's happening as we speak. But the biggest factor that we see has been this emergence of AI. So when you look at the decision tree in 23, and I would say the same for 24, where we sit in early January, the CapEx decision is not an and or an or transaction for these major hyperscalers. It's purely an or. So as these customers are shifting, and to keep it, in an overall simple, if a company had a $10 billion CapEx number, and initially prior to AI's emergence, it was 10 billion core data center, split between 8 billion core x86, 2 billion GPU. When we cycled through last year, it ended up being, an incremental billion or two came out of the core data center x86 and all flooded into the AI GPU-based ecosystem. Our sense is that continues into 2024 and at least through the first half of 2024. To give you some additional numbers behind it, we do think NVIDIA is probably the best proxy of the overall health of the AI marketplace. In their data center group in calendar 3Q, that is calendar 3Q 2022, was roughly a $4 billion business that as of 3Q 2023 went from 4 billion in the previous year to 16 billion. So it was really a 400% increase with significant size from it. So we do see that business approaching 18 billion in the fourth quarter, probably 20 in the first quarter before starting to stabilize. So tremendous growth in AI. We do think AI is real. What I will say though, in our big questions and concerns, and we'll address this a little bit at the end, we're still trying to figure out use cases. We're still trying to figure out network architecture. We're still trying to figure out interfaces, all of those things. And we think that holds true. So as we get into the back half of the year, again, we think the AI side of the business stabilizes, admittedly stabilizes at a very, very high base, but we think we come off that exponential growth curve, probably at the end of the second quarter of this year. When we shift from compute and we look at the smartphone market, again, looking backwards, really challenging year, predominantly at the expense of China. That was slower in the margin. And as you can see for 24, we do have a couple of points of growth built in there for the overall smartphone market. We do have substantial growth as 5G continues to proliferate globally. But I would tell you, when we think conceptually about smartphones overall, we think this, low billion, low 1.1, 1.2 billion range is probably kind of your perpetual number. So we think the curve has flattened a touch in terms of smartphone growth. And I think that's evidenced by where you're seeing the growth right now. India is arguably the best smartphone market, but their appetite is predominantly for refurbished or pre-used iPhones. So again, kind of good for Apple, but also not great for the rest of the supply chain, as you're only getting one sale, on a device that's used multiple times. So again, a relatively cautious or guarded low single-digit type growth in smartphones for 2024. When we shift out of the consumer facing and then start to look at the automotive marketplace, would tell you, it's kind of a good news, bad news scenario looking at both 23 and 24. From a good news standpoint, we think global production finished in the 80 million, which is both good news and bad news. The good news is, the forecasts on Jan 1 of 2023 were 80 million. This is the first year since COVID started where we haven't had to dramatically walk the production forecast down. So at least the forecast, albeit with very nominal to no growth, at least the forecasts were in line. So that is, good growth, or I'm sorry, that is the good news. The bad news inside of that, and I think the bad news, again, when we look out at 24 and 25 and beyond, we see very limited catalysts to take us back to that 17, 18 range where we were hovering in the 90, 95 million unit range. We think we're in the low 80 range. So we think we are moving into a much more moderate production growth environment. And I would say the other challenge we've clearly seen some wind come out of the sails from the EV marketplace. Now, what I would tell you with EVs, and I don't have any slides in here today, long term, the EV marketplace is fine. In our forecast, top out at roughly 35 million units by 2040. So again, it does grow as a significant percentage of the mix. Those long-term forecasts haven't changed. What we're dealing with right now is we're really dealing with the rationalization of the OEM base. Like it or not, there are really two OEMs with significant scale in the EV space. One being Tesla in the West, the other being BYD in the East. And outside of those two, what we've seen is either legacy internal combustion OEMs with limited scale in EVs struggling to introduce products that are desirable at the right price point. So we've seen a rationalization of introductions in the internal combustion side. And then we've also seen your emerging OEMs. We've seen the challenges arrive there, right? So these are emerging OEMs started in the EV marketplace without the scale and or significant intellectual property to differentiate themselves. And we see those guys, cutting production and facing significant challenges. So we are seeing a touch of a shakeup here in EVs. And what I would tell you again is this is natural when we come out of that hyper growth phase of any new marketplace. As we shift from production, we look at automotive end demand. This is the SAR here on a monthly basis dating back, well over 10 years. So, again, 2023 was kind of a good news, bad news. So when we started 2023, our forecasts were for 15.5 million units in the US, plus or minus, call it 250 grand. The good news is we came in about the 15.5, 16 million range. So kind of in line, even maybe a scooch above the inline or the higher end of our forecast. So that's the good news looking backwards. The challenging news with it, is really twofold. One was mix. So the mix was driven last year predominantly by fleet. Fleet tend to carry less technological or less technology. They're more mid-priced cars, et cetera. So we had somewhat of a mixed trade down. That was a challenge. And then the other is simply dealer level inventory. Dealer level inventory bottomed in 1Q22 at I think about 19 days of inventory. Exiting last year in the December numbers, they were at 71 days of inventory at the dealer. So again, inventory is filled. I don't know if anyone on the calls looked at car lots, but here in the Boston area, there are plenty of cars available that are covered with a significant amount of snow. So that's kind of the environment that we're setting up for 24. What are we thinking of the SAR in 24? We think it's kind of flattish for the year. And again, we think that ultimately works. So, a flat 15.5, 16 million SAR number with content additions and, still growth in EV as a percentage of the mix, that kind of gets you to your high single, mid to high single year over year automotive growth if you're a component vendor. The catch I would say this year is we are starting the year off from a component side. There is inventory available that largely stems from some of the strikes in the continued procurement in Detroit. So we do have some inventory to work through. So we're thinking, again, the automotive marketplace from a component supplier standpoint is also probably closer to flat as the OEMs do work through inventory. Shifting from automotive and looking at the industrial world. So to show the market at the highest level, showing total manufacturing here in the US, and everybody on the call or the webinar could see the clear moderation that we've seen since early 2021. Some of that is simply the math, right? We had the COVID shutdown years. You had you lapped the COVID shutdown months. You lap those. It drives your year-over-year growth. But we've kind of moderated off those levels. So again, how do we think about it? And I think the broader economy is in play. As we went through 2023, the economy was resilient. It showed a significant ability to bend, not break, which is a good news. But again, we think it's more of the same this year. So we think from the top-down standpoint, the overall market is kind of flattish from a manufacturing standpoint. There are several catalysts, including automation, including robotics, energy efficiency, that should drive the industrial marketplace to be, again, that mid-single-digit grower. But similar to automotive, we're also starting out with an inventory challenge. So 6 months to burn inventory, very limited bookings. We think this does fit in that narrative of a transition year where the industrial market is kind of flattish overall, kind of in line with the top-down trend. From a defense or military standpoint, and I'm sure everybody here has read the news as it relates to the industry, and what I would say is I think we all know, and I'm not a geopolitical expert, but what's going on in the Ukraine, what's going on in the Middle East is obviously a number of geopolitical tensions that at the headline would say, oh, that's driving the spending in our industry. And I think what you see over history is actually we've been on a relatively long-term secular increase prior to Ukraine, prior to the conflict in the Middle East. And again, not making light of those by any stretch. But what I would tell you as it relates to those probably on the call, it's not as much it's more of what we're spending on versus how much we're spending. So if you really dig through Pentagon budgets, it is clear that we are in the midst of a digitalization, if you will, of our overall defense or military. And really, it's in preparation to fight the war of the future. And unfortunately, the war of the future is viewed to include hypersonic missiles, satellites, cyber warfare, and will likely be fought over the Pacific. So again, we're seeing the defense network here in the U.S. become more digitalized, driving a higher percentage of the overall spend into our industry. What does that mean going forward? We think it's more of the same. Unfortunately, with the multiple conflicts throughout the world. And again, so we think that does serve as a tailwind, but then we have the kicker of the digitalization, and we do think we're in a prolonged period where component sales into the military are again mid to high single digit type growth environment. Before shifting over to our forecast, I'll touch the WSTS had their revision out mid-November, and they're calling for a 13% growth this year, 7% ex memory. And I'll go into our numbers later or on the next couple of slides. But what stands out to me, and while I struggle to kind of fit the square peg through the round hole with their forecasts, when you look at that 2014 to 2019 CAGR, whether it included memory at a 4% or ex memory of a 3%, when we look at just the COVID years, so 20 and beyond, with memory, growth rates are expected to have doubled, and excluding memory, they're expected to have tripled. And rhetorically, I'd ask everyone, can you name a market of size where the growth rates have accelerated 3x what they were prior to COVID? Yes, we know EVs came and they're significant. I talked about AI, but right now we're just now getting to the point where they can move the needle, right? So they weren't really the catalyst in early the COVID years. So to us, these forecasts or these numbers simply go back to that inventory slide that I've showed earlier. We have too much inventory in the supply chain. So where do we stand at Edgewater? And I know I've kind of thrown a lot at the audience today. So I'll start with our forecast for the semiconductor industry. So to start, again, I said it earlier, we really view this year as a transition year prior to returning to true growth or trend growth in 2025. So again, what does that mean from a numbers side? Excluding memory, we're at 2 to 3% year-over-year growth, with the first half continuing to digest inventory. Hopefully, we start to see some stabilization in book-to-bills in 2Q, and then a return to growth in 3Q. And then when you bring the memory side, the growth rate effectively doubles to 6%. What I would tell you with this forecast, if you run through kind of upside, downside scenarios, we do think there's likely more downside risk to our forecast than upside risk to the forecast, and it's really driven by kind of one thing in particular. Unfortunately, outside of distribution, nobody knows what inventory is in the supply chain. So it's eerily similar that at this time last year, we were calling for a 6-month inventory correction prior to returning to growth. The difference, of course, is now we're 6, 9, 12 months in some cases into that burn. So inventory has made some progress, but at the end of the day, again, we just don't really have a great handle of how much is out there. So, we do see inventory as the biggest risk to this year. But again, from an overall risk standpoint, we don't think that up 2 to 3 goes to a down 10 or anything else like that. It would probably be kind of flattish to down slightly at a worst case scenario. Shifting from semis into the interconnect marketplace, I'd say it looks very similar to that broader ex-memory semi with kind of one caveat. In 2024, our growth outlook is more in that 4 to 5 or 3 to 4, I should say, so a point or two higher than semis. And I would tell you the real delta from our standpoint, from an interconnect and a semi side, is purely inventory, and ultimately that stems from the use of the non-cancelable, non-returnable programs. The interconnect suppliers were not nearly as aggressive throughout the COVID years with the non-cancelable, non-returnable programs, and as a result, they simply had more progress in burning inventory. So, again, we are a little bit more optimistic on the margin for the interconnect fundamentals this year relative to semis. But again, still think it's kind of a transition before we return to that 5-6% year-over-year growth in 2025. And lastly, I'll touch on the passive side, and I think passives is a case of kind of good news, bad news. The good news is, the inventory issues hit earliest for the passive suppliers. So there are signs that inventory has bottomed, in particular in Asia. From the passive suppliers. So that's the good news. The bad news, I would say, in passive is as we're seeing much more of a willingness to play ball on price. So as we start to see a potential recovery in bookings and some level to test the elasticity, we are a touch concerned that the passive suppliers could lean into price more in 2024, and that's what keeps us more muted relative to interconnect and relative to semis. Lastly, before questions, things that we're watching for this year and beyond, and I talked throughout the AI sections and really throughout the presentation. We do think AI is real. We haven't figured out the user interfaces yet. We haven't figured out the monetization schedules yet. There's a number of aspects of the business that we haven't figured out yet, but again, it's real. So we're watching to see, just how the market reacts when we get into some sort of stability or, call it normalized growth outside of the arms race that we've seen recently. Geopolitically, I think it'd be naive not to be paying attention to China and the U.S. in their, quote unquote trade war. The TC+1, Taiwan, China optionality, whatever the buzzword inside of your organization, is very real. There are not any simple answers to it, but it's ongoing and something that we're watching closely. And then, competition, pricing, sourcing, second sourcing. Again, we've been through a very, very disruptive period. I think it's worth noting that despite all the disruption, the industry flourished. But again, coming out of it, it's what lessons are ultimately learned in terms of supply chain resiliency, supplier-based resiliency, things like that, that could change the competitive dynamics in the industry. So I know I've covered a lot. With that, I'll pause here and see if there's any questions from the audience.
Okay, looks like we do have a few questions that just came in. The first question is, what do you think on the AI market near term and longer term?
Yeah, so touched on it kind of briefly throughout, but to summarize it in one sentence, I think the outlook for the first half of the year is still very robust. We're in that quote unquote arms race. We're in that deployment phase. So near term, meaning the next 5-6 months, I think it's more of the same of what we saw in the back half of 2023. Where it does shift a little bit is in the second half of the year. Part of that is just a stability factor and kind of a law of large numbers, but also it's understanding kind of the use case or monetization. So near term, we have seen some moderating of orders. We've seen some better availability from NVIDIA products, which all point to again, at least some level of kind of moderation here near term.
Great. The next question is, what has happened to the EV market and have the product cycles ended?
Yeah, yeah. The short answer, and again, it's I kind of weave that into the broader auto commentary. The product cycle has not ended. If you think about giving a nod to one of our competitors, the Gartner hype cycle, we collectively, when these new technologies emerge, we go through the rapid growth, we go through the correction, and then ultimately we enter into the sustained growth period. So I think, right now we're in that quote unquote correction period. And I don't think that means units are going to fall or anything else. But what we are going to see is OEM offerings are going to have some type of competitive value proposition. And to date, where we sit right now, there actually are only two OEMs that can offer that. One being Tesla, and the other being BYD. So, when we think about it, between legacy internal combustion, I think they all tried to make the jump from ICE vehicles to EV and skip and ultimately skip that hybrid one. I think you're going to start to see a touch more of their R&D spend to build up a hybrid offering, because candidly, what they're wanting to, what the consumer is looking for is not an $80,000 vehicle. If they want an $80,000 electric vehicle, there's only a certain number of people that can buy those, and B, they're probably going to go to Tesla. So, from the internal combustion, you're going to have to see, I think, actually more of an emphasis probably on hybrid going forward. When you think about some of the emerging OEMs, I think there's just actually going to be some level of consolidation. When you think of the OEMs that are producing, 10, 15, 20,000 vehicles max in a year, they quite simply don't have the scale to compete with somebody like Tesla that builds and sells a couple million of them. So, I think the trend continues, but what you're going to see is the customer base. There's a big shakeup. So, I think, in years past, if you were in Detroit, you took for granted you had an EV growth kicker with all your customers. I don't think it's that easy right now. And I think it becomes more project or platform specific than a broad market, or rising tide carries all ships.
Awesome. All right, looks like we have, I think, one last question. When do you think the inventory will bottom and at what levels?
Yeah, that's a great question. I sat at EDS last year, and one of the executives from one of the large distributors said, we went from just in time to just in case to just too darn much. So I think we all know that, and it's kind of a funny, pun, and I like repeating it. But, to the point of where we are going forward, our best guess right now is we've got another 6 months to burn inventory. So, what does that mean from a dollar standpoint? Days is probably the best way to look at it. So, I showed it on the slide earlier. We're 34% higher on a days basis exiting 3Q than we were prior to COVID. So we've probably got somewhere in that, call it 25, 30% of inventory to work through, which hopefully we can get it done here in the first half of the year.
Great. I think that's all the questions that we have for today.
Well, excellent. Well, thank you everybody for joining us today. I hope this session was valuable. I know the team at Octopart will have it available via their YouTube channel, all the social programs. So please feel free to reach out. They'll have a copy of the slide deck. Reach out to me directly. Would love to connect with all of you. Thank you guys very much and have a great day.